and welcome to the latest Retire Well episode. As always, you're joined by Matthew and Joe, and today we're going to talk about how a financial planner can help you, and we're going to look at what a financial planner does. We've had a few comments about, what a financial planner does and what's the difference between different types. So that's what we're going to cover today. It's definitely a topical time to talk about how a financial planner can help, because we've currently got a period of market volatility and people are rightly looking at the news and thinking about how's Trump affecting their pensions and their potential retirement. So I think, one of the key reasons someone wants a financial advisor is to know you've got a trusted expert in your team and someone who can, hold you to a financial plan and reassure you during the difficult times.
Yeah, absolutely. I'm sure we'll touch on sort of the benefits and drawbacks of a financial planner throughout the episode. We'll look at sort of what a financial planner does and doesn't do, where they can add value, potential fees, which is always a question that people have, and maybe potentially how to go about choosing a financial planner. Matthew, I thought it was probably a good place to start off, because I hear you talk about it quite a lot. How would you explain what you do if your mum asked you? Like, how would you explain it to her?
Okay, that's an interesting one. I see financial advice as giant problem solving. So a financial advisor is helping someone to identify and understand their own financial position and objectives, and then to say, with their financial resources, whether that's pensions, ISAs, income, rental income, all those sorts of things, with those Lego bricks, putting them all together, how can you best solve their objectives? And again, sometimes that's thinking about opportunities. So it could be this is something you could do now. And equally, it could be, okay, you can't tick off all 10 or all 5 or all 3 of your objectives today, but you can start working towards number 1, working towards number 2, and have a focus on that. So I would say, yes, my mum would say, Matthew works in pensions, or Matthew helps people retire, or Matthew helps provide financial advice. But I think the higher level step back is more financial problem solving. What would your mum think that you do?
Yeah, I'd say similar sort of things. Whenever I talk to my mum about it, she says it's in finance and doesn't really go beyond that. But I think, generally most financial advisors will be holistic financial advisors, which essentially means look at all areas of your finances, how they interact. And if you make a decision in one part of your finances, how might that impact you either now in a different part or even further down the line? After that, then you can maybe look at financial advisors that specialize in different things, or maybe even just have a preference for dealing with certain things. So us as Wealth of Advice, we very much have a focus on people at retirement planning that sort of coming up to retirement or maybe just after retirement, about how they can use their pensions to work well for themselves. But just because we look at that doesn't mean that we're not looking at sort of the estate planning side of things, how to pass on to the next generation and sort of more wider arching investments.
Yeah, I think the holistic phrase that you use there, again, we're an industry full of jargon, and someone could say, what does holistic mean? I think holistic means, we're going to ask someone the wider questions. We're not just going to say, you have a pension, we'll talk to you about your pension. We're going to say, okay, what's your house worth? What's your estate worth? What's your views on gifting money? Have you got a will in place? That, for me, the holistic bit is to say, we're not focused on just a pension or retirement. We've got that wider focus to say, we'll help you with everything of a financial nature. And as you say, how do we weigh up things? That's where we're able to get involved in the wider bit to say, okay, can you afford to put more into a pension? Okay, maybe you want to put it into something like an ISA. That's an investment that goes alongside the pension. And equally, some people might have, as I said, rental income and other things. So it's the bigger picture rather than saying, no, you just deal with that and we look at your pension. So I think, one of the things we're going to talk about today, and one of the things that people find hardest with financial advice, is everyone who calls themselves a financial advisor, might have a different focus or a different specialism, and they might be trying to do something different. So again, some people almost look like a financial advisor, but might be a mortgage advisor. Someone might look like a financial advisor and be someone who specializes in protection, so life insurance. Someone also might be a financial advisor who then specializes in expats or overseas, clients. So again, that's the problem. I think for some people, it's like you put everyone in the same basket, but you might get very different results from a conversation with them. Do you think that's fair?
Yeah, I'd completely agree. I think when as well we're talking about a financial advisor, I mean, in Wealth Advice, we have Matthew's a chartered financial planner. We'll come on to that later. I call myself a financial planner. There's lots of different phrases that financial advisors might call themselves, but under a sort of broad bucket, it's all the same thing. And it very much depends on sort of what area they might specialize in or where they see themselves add value to clients.
Yeah, and there's like a newer side of things now where some people call themselves financial coaches. Again, that might be someone who says, oh, well, I haven't actually got any qualifications, but I've just got an interest. Again, that can be dangerous because people can assume that they're talking to people who have done the exams and have got the qualifications. Again, some people follow things that Martin Lewis say as if it's like gospel. Again, he's really good at highlighting areas for people to think about their own finances, but he then doesn't have the qualifications in pensions, investments, tax, and that sort of thing to be able to say, this is my advice for you. He's providing guidance generically, and some people might, wrongly take that as advice for them, and they could react accordingly rather than, looking at their own circumstances and decide themselves. For us, we are regulated. We're regulated by the FCA, and therefore any formal advice we give has to be in someone's best interest, and it has to be identifying their view on risk, their objectives, their full financial position. And without having that two-way conversation with the client, we can't give that. Martin Lewis obviously doesn't know that about any of the people he's emailing or speaking to on the telly. He's just very much saying from a generic position, this is what you might achieve.
Yeah, absolutely. I think it's important to sort of look at qualifications and regulation, and we'll come on to that a little bit towards the end of the podcast. But I thought it'd be good, Matthew, to almost run through what steps do we take with clients with regards to financial planning? How do we essentially come to a recommendation, just to give everyone a little bit of a feel of sort of what we do on the day-to-day and sort of how and where we can help? So do you want to start off with sort of, I suppose, the first meeting or what you might do there with regards to goals and objectives?
Yeah, I think the first bit of contact is obviously someone reaching out to us to say, I've been referred to Wealth Advice, or I've come across your website, or I've listened to the podcast and I'd like to get in touch. And they're coming with their problem, or they're coming with their objective. So someone might have sent an email, had a phone call, or had a first meeting. At that point, we're very much trying to find out lots about you. And again, we're almost sharing information about ourselves and our process and our fee structure. So the first meeting is very much a two-way. Do we want to work together, and what can we do? It will be lots of questions. So it's almost that, what have you got? What are you looking to achieve? And then we can start building upon the information.
Yeah, I very much see it as almost understanding the why behind the clients of why they're getting into financial advice. What are they looking to achieve? And why are they looking to achieve it? Because then you can start to break down sort of more quantifiable objectives about how do we actually get to that, as opposed to someone just coming saying, I need financial advice.
Yeah.
As we've said before, there's lots of different types of financial advice that you can have. Yeah. So having that first meeting and identifying sort of what they're wanting to achieve is really key. Also in that meeting, generally, we'd sort of, or most advisors would look at sort of your level of risk that you're willing to take. If you're looking at sort of an investment or pension side of things, and that is, I suppose, a two-way conversation again, as most of financial advice is. Most advisors would run through a risk profile questionnaire in that first meeting, which is very much just trying to almost, I mean, some people might say sticking a finger in your ear, but it's trying to get an idea of what your natural attitude to risk is with regards to investments. And I suppose trying to take the jargon out of that is, how comfortable are you in investing in the stock market? How does it make you feel? And sort of, do you need to take that risk?
Yeah, I think we talk about any investment has an element of risk, and we're saying to someone to start off, what is your view on risk? That might be their past experience, that might be their level of understanding, and it might be almost their gut feeling as a person. I wouldn't be able to sleep at night if my investments, fell in value. That is saying to someone, okay, you don't want to have something invested in the stock market. We also take into account their capacity for loss. So for me, your attitude to risk is the level of risk that you're willing to take psychologically, and your capacity for loss is the element of risk you're willing to take with your financial plan. So if someone has no debt, lots of guaranteed income sources, and lots of assets, they've got a high capacity for loss, but again, their psychological level of risk might be higher or lower. That's for us to identify. Someone else might have a very, very low capacity for loss where their financial plan currently just about balances, but if their investments were to fall by a few percent, then it wouldn't work. Even if they came in and said, I'm highly speculative, I can tolerate risk, if their financial plan, their capacity for loss wouldn't accommodate a fall in value, that could be restrictive from that point of view. So I think for some levels of financial advice, you don't almost want to feel like you're jumping straight into assessing risk, because you want to first of all understand the person, the whys as you describe, and the objectives. But then once you're starting to get into the planning, that's when risk is, the key bit of, I can solve your problems with 1, 2, 3, 4 options, but I need to know that you're on board with a level of risk. If not, that would rule out these investment products, and we would only then be looking at more guaranteed solutions, maybe cash-based investments or annuities if we're looking at pension income. But again, that is that two-way thing from the first meetings.
Yeah, I agree. That first meeting, like you said, is very much about the why, and the risk essentially helps you work out what solutions are applicable and what solutions might not be. And it also actually helps us guide ourselves in the research side of things, which is the next thing that we're going to come on to. So generally, I'd say most advisors probably use a 2 or 3 meeting process when it comes to new clients, where they'll sit down, understand the why, get all the relevant information they need. That might be the hard facts, the soft facts, and why you want an advice. And then also look at any current products that you might have. So that might be existing pensions, investments, or it might be looking for sort of a longer term plan on how we might draw down from it. And they'll go away, do some research with the, I suppose, technical team or paraplanners about how, I like to call it a financial MOT sometimes, where is everything in the right place at the moment? If not, what needs to be put where to get it where it is?
I think you might have stolen that from me. I like the what's under the bonnet and checking it. So I think that makes sense. I think the 2 or 3 meeting type approach, I think it depends how much information someone comes with. I've had clients in the past that come with spreadsheets and their own systems, their own models, their own almost plan of what they think they want, and they're wanting that sense check. Again, the more information someone comes to at the first meeting, the more useful you can get into a deep dive. And the person who comes to sort of say, I think I need financial advice, but I'm not sure, that's a longer process than the person who says, I've identified a specific objective that I'd like you to explore. Yes, we still talk bigger picture, but we can start getting into the details straight away. And you're right, some people might think of financial advice as coming, sitting over the table from yourself or sitting over the table from me and having a conversation. There's a lot more that goes into it behind the scenes, writing away to every product provider you've got, getting the technical information. And like you described, the technical research element is then is there anything that's going to be not in your best interest? So again, someone might say, I should consolidate my pensions because it makes sense to move my 5 into 1. Again, in theory, that could be perfect. But what if 2 or 3 of those pensions have got something valuable that you don't want to give up accidentally? So that's where, a robust process behind the scenes comes into it, definitely.
Yeah, absolutely. And then sort of after that, you'd look at sort of where stuff is. Do we need to make a recommendation? We won't, I suppose, run into detail on recommendations because they're highly specific to the clients. You might be looking at one aspect of the financial plan or sort of holistically all at once, as Matthew said. But generally, it's sort of a summary of your current position. Does it need to change? If so, why does it need to change? And as Matthew also touched on there, we also look at what we haven't recommended, which I think is always a big thing to look at with a financial advisor. Yeah, because it's important to know why we aren't recommended things and discounting alternatives.
Yeah, I think that is like going back to school. That's showing your workings out. It's a case of we've looked at all these things for you. This wasn't relevant because of this reason. This wasn't relevant because it was too expensive. This was too high risk. This was too low risk. We've got to the Goldilocks approach of this is just right. I think what we've done here is we've jumped into the structure, the process, and I think that's really good because some people go, I don't understand what I'm going to get when I walk in the door with a financial advisor. But I think for a second, if we jump back to say, what does a financial value, what financial value is added or what value is added by a financial advisor, that's the harder bit to answer without thinking specifically what problem someone got. But if we think about some of the phone calls we've had recently and some of the things that people have been dominating the headlines, investment volatility, choosing where to invest, choosing whether you should have money in a pension or whether you should allocate money towards a pension, an ISA, a cash account, an offshore bond. Again, lots of jargon, lots of products. That's where a financial advisor can really take all of that stress and worry away by saying, we have a long-term plan, we have a process, and then when something comes along, like we have recently, where there is market volatility caused by Trump and the tariffs, we can be that reassuring voice to say, no, stick to the plan. There's nothing that needs to change. Yes, we can see values changing on a daily basis, but for you, it is a 20 or 30 year plan in retirement, and it's only the short-term numbers that people are affected by if they were pressing a button to panic and sell things, for example.
Yeah, I think that's a good point. And touching on the investment thing, I think it's quite a common misconception among clients that your advisor, this is like me trying to pass the buck because the markets aren't doing too great at the moment, that your advisor is solely responsible for investments and investments only. And I think in the past, particularly sort of, I don't know, the early 2000s and beyond, that very much was seen as the general thing for financial advisors, that they are responsible for driving investments and they're responsible for any growth. I think now there's probably more of a split than there was previously with regards to the investments and the advisor. So although we have an overarching review and a knowledge of the investments, and in the case of wealth advice in our firm, we do have an investment committee that sits on with a fund manager and helps structure the portfolios. But I think a lot of the value comes from the bits around the outside. So as Matthew's mentioned there, the sort of, I suppose, behavioural coaching, that when stuff doesn't go right, the sort of reassurance that we are in it for a long-term plan.
I think what's important there is a financial picture is all encompassing. So it's very hard for someone to pull out the tax efficiency, the death benefits, the financial planning bit, and separate that from the investment returns. We know that the market drives returns and performance, but we know an advisor sits with a client to agree the level of risk, the financial plan, and therefore where those investments are held. So there's an element of, you can't control what Trump does, you can't control what the markets do, but you can, as a financial advisor, work with someone to identify how much risk should be in a portfolio. So, we talk to our clients and say, is it 60% in equities that's appropriate? So 60% in risk assets, or is it 40% in risk assets? Again, there's almost lots of options in between. But for us, that's where we are sitting with the client to help make that decision. Ultimately, the fund managers who are making the day-to-day decisions with the money are the large specialist firms that we trust with the money. And then we have the ability to move between funds depending on what's happening in the world. That's where we have to feed into an investment process, and we have to listen to economists, fund managers, and also the voice of our client to then also feed that in with what we hear data-wise. So I think that's where fund managers do one thing and advisors then feed in, but neither can control the market. Both are reacting to what's happening in the market and what our clients are saying. It's human nature that someone would say, if everything goes up, they're going to be happier, and if everything goes down, they'd be sadder. But I think there's an element of what you're trying to say is almost, we can guarantee the right financial decisions and the right tax position and the right death benefits, but what we can't guarantee is the underlying investment performance.
Yeah, and I feel like sort of the softer side of financial advice, which you almost described there, is quite hard to quantify in sort of how does that affect returns.
Yeah.
As Matthew knows, and as you'll probably know now, I do quite like figures. There was a big sort of research paper a few years ago now called Advisor Alpha, where it's trying to look at how much value does a financial advisor add to your investment returns. It's run by Vanguard, so they did have an advisor, so that they might be slightly biased, but they reckon that it's around 3% net return to clients on an annual basis. And they've essentially looked at it and sort of what bits do an advisor add to the portfolio. Obviously, you've got the standard sort of stuff of, is your asset allocation correct? Are the fees there or thereabouts? But they attribute almost 1.5% to that sort of behavioural coaching that you're on about, Matthew, making sure that you're making the right decisions and not, for example, in the last month, selling to cash so that you might not get a potential rebound
rebound.
That's what I was trying to say. And then the other side of that is the sort of withdrawal order and use of tax efficient allowances. And I think that bit is a bit that we haven't spoke about as much just so far on the podcast, but is a really beneficial part, because when it comes to drawing from pensions, there's a lot more complexity than building up the pensions in the first place. Matthew, do you just want to talk on that really, really quickly?
Yeah, I think touching on both things. So touching on that study, you're right. I can recommend a pension, or we can recommend a pension, and we can recommend an investment solution that could add value over the long term. And it's about picking the right level of risk. Someone could equally go and invest in a pension themselves, but they have to then pick the risk themselves, and where are they coming from it that way. So that's where that study's seeing the advisor as adding value by constantly reviewing things and picking the right investment for you. And then thinking about what you just mentioned there on the tax efficiency, that is also a similar thing of, if someone says, I want income of £2,000 per month, or I want 10 grand as a lump sum, we say, okay, what's your tax allowance? Have you used your personal allowance? Have you used your capital gains tax allowance? We can take a bit from here, and then get you to the lowest tax position. Again, the DIY client might say, I need 2, I need 10. I'll take it from there. I might miss something. So I think that certainly adds up to that bit. And overall, that study was looking at it and saying, financial advice is adding a monetary value in terms of better returns for the longer term and, more tax efficient. But it was then also adding the emotional side of things, the support. I've had a few client conversations recently where the person goes, I know what you're going to say, but I just, want to go through the process. So I know I've asked the right question so I can reassure myself. Again, that sort of relationship's completely fine. I also have clients who say, can I have a quick 10-minute chat because I'm thinking about changing job? Is there anything I'm missing? I'm thinking about selling the business. Is there anything I'm missing? Some people might not having a good time at home. There might be a divorce on the cards. Am I financially stable enough that I can afford that? Again, it's giving people the peace of mind in their own lives to confidently make their decisions. So for us, financial advice comes in lots of different forms, and it is very personal, and each individual knows what they want out of it. I have some clients who would text me. I have some clients who drop me a WhatsApp. I have some clients who will message through our app, and others who will ring me. Again, it's the two-way relationship is to understand what's best for that individual. I've got one client who's always on the road. So instead of having, a face-to-face annual review, he would prefer multiple conversations throughout the year, and that would add more value. Again, for me, that's what we do really well, where we identify what someone wants from financial advice and we offer it to them, rather than saying one size fits all for a model.
Yeah, absolutely. I think that covers pretty well sort of most of the benefits of a financial advisor, unless you've got any sort of other bits you want to add before we move on to sort of how to choose an IFA and that sort of thing.
Yeah, I think that covers it. I think there's a lot more that we could go into, but I think it's the hard thing. We're possibly the wrong person to say what a financial advisor does well. When we listen to our client testimonials and what people say about us, that's the fairer reflection of what we do well. And I think some of those messages there are peace of mind, a sounding board, someone who's always available to help and care. I think that's important. And I suppose that does come into how do you pick a financial advisor. So if we move on to that bit, some of those bits will probably come up as well.
Yeah, absolutely. I mean, the very basics of what you should look for in a financial advisor, first of all, they need to be FCA-authorised. So that's authorised by the Financial Conduct Authority. Easiest way to find out about that is by searching the name on the FCA register. If they don't appear there, or they appear under a different name, something's probably gone a little bit wrong. And by doing that, by going through an FCA-authorised advisor, you get all the consumer protection surrounding it. So I think that's the main point. I'd hope that most advisors that are practicing in the UK are, and there's no one that's trying to pull the wool over your eyes, but that's something that you should look at.
Yeah, definitely. And people have seen the FCA advert with a fake financial advisor on a jet ski. By checking the FCA register, you're making sure you're not transferring money to the guy who's going to go off on the jet ski. Some of the common things where people need to be careful is you should be sending money to the financial product that's been recommended. So, if it's a household name like Aviva, Standard Life, Aberdeen, Royal London. They're the sort of names where you should be making out your checks and making your payments. If you were making a payment to Joe's personal bank account, again, something would have gone horribly wrong with the payment.
Yeah, absolutely. After that, I suppose the next choice that you have with regards to a financial advisor is looking at a restricted or an independent financial advisor. Matthew, do you want to sort of run through what the differences are?
Yeah, so traditionally restricted tends to be more focused to things like banks because they might have their own product range, and an advisor sat there can only recommend from their own product range. But we also see that with some big financial advice firms where they might have their own funds, they might have their own advisors, and they might have their own platforms where investments are held. And basically, if you go to them, you can only get that solution. When we think about independent financial advisors, they are someone who can recommend anything from the whole of market across every product, every investment. And by doing that, they can then pick what's best for you rather than what's best from their offering. We're an independent whole of market firm. Some, restricted, sales piece might say, well, we actually have the best propositions, so therefore, even though it's restricted, we're giving you the best thing. Okay, fair enough. But from my point of view, being able to review the whole of the market, being able to review every solution has to be the right thing for that client's, best interest.
Yeah, absolutely. I suppose also from the sort of restricted point of view, if it is through a bank and they've got a streamlined process, it might be that they can almost lump all their fees into one fee and essentially make it, I suppose, more simple from a fee perspective. But like Matthew says, you lose out on the variety of investment options that you can choose.
And sometimes simple can also be opaque because you don't know what you're paying for each bit. So
yeah, absolutely. From a fee perspective, I'd say the vast majority of financial planners in the UK work on a percentage basis. It's the traditional way that financial advisors charge. So if you were to come in with an investment amount, you would essentially get charged a fixed percentage for the initial fee for looking at where you are at the moment, where do you need to be, and what changes do we need to make to your portfolio. And then generally for the sort of ongoing management side of things, which for me, I think that's where a lot of the benefit comes from in financial advice, there'd also be a percentage fee there. The vast majority of the time that will be charged from your investment. So you don't see it come out your bank account. You don't have to turn up with a check or cash to pay your financial advisor. If you do, then they're probably not on the FCA register, as we mentioned, and something's got wrong. But that's one way that you can look at it. The other side that you can look at it with regards to sort of paying for financial advice, because you don't actually have to have investments to take advice, is you might look at paying for it on a fixed fee or an hourly rate charge. Yeah. And for me, I see those more as, it's less common, it's becoming more common in the industry now, but it's almost like a project fee where, similar to a solicitor or an accountant, you ask them to do one set specific thing, and then you charge the fee for that, and you might not get the rest there. But what are your thoughts on that, Matthew?
I think the industry has the percentage fees. So if you walk in the door, you've just won the lottery, typically there's going to be an initial fee, which might be, 2%, 3%, 1%, for example. And then there's going to be an ongoing fee for financial advice, which might be, 0.8%. Again, that makes sense and people can understand it. The project fee, again, can make sense when there's not funds invested. So you could say, I've got an inheritance tax problem and I've got properties, or I want to understand it more. It makes sense that is okay, here's the agreed fee, I'm going to look into it. The funny thing I think about the hourly rate is it makes sense for the client on paper, but a bit like a solicitor and accountant, if you're always suddenly the time's running and the clock's ticking, you don't actually necessarily realize how much goes on behind the scenes. Again, when we talked about the technical bit and the research and all the work that does happen, actually that ends up being quite a lot of time spent. I know certainly we've had cases where we've had complicated cases, and when you look at the time spent, it's been remarkable. So yeah, I think the percentage models work for the majority of people where there's funds to be invested. They're getting good value because, over the long term, your fee is also proportionate to your growth. So as an advisor, we're then incentivized to try and do the best for you. And I think that certainly makes sense. I suppose the other fees is the things that we wanted to think about as well. When you're comparing financial advisors, you want to make sure you're comparing apples with apples and you're getting the fee for the advice and the investment and the platform. Some, more sales-based advisors might just quote one figure, and then actually when it comes into it, there's additional charges which you haven't really seen.
Yeah, sure. I think I'm pretty happy with that for fees. The only thing there's lots of other things that you consider when looking at the financial advice, but the only other thing we're going to cover today is looking at qualification levels.
Just one little bit on fees.
Sure.
I find sometimes people who get in touch who are purely focused on fees are missing the point slightly. Do you see that? Do you see that as well?
I think quite a lot of times you'll get someone called up, and in the initial email it'll be going, I want financial advice, what's your fee for it? And it's quite hard to work out what fee they need to pay because you don't know what the financial advice is.
Yeah.
But it's in my view, if you chat about fees before you talk about anything else, they don't get to see all the value which they provide. Which is why most financial advisors, and we do it here, is we provide sort of a initial consultation where we'll sit down, look through the goals and objectives, and start talking about where we can actually add the value, and then talk about the fees. And we provide that initial consultation at no cost, which I think's an important thing to do, because someone wouldn't just go out and buy a car because it's the cheapest.
Yeah.
They'd go out and buy a car because it's the car that they want. They've looked under the hood. They realise that it's going to get them from A to B.
Yeah.
And there's a fee comes into it.
It's a bit like buying the cheapest parachute. It seems silly, but some people will still go, "Ooh, I still, what's that cost for it?" I think, one story I've got is, we're a business that very much works through referrals. And if you do a good job, someone refers you to, a friend, family member, colleague, and then they come in for advice and they've already a fan, so to speak. I had one client who was a retired head teacher, and she was the most cynical person because she'd been stung in the past by poor advice and bad investment performance. So she came in and said, I wouldn't have even come in the door, I wouldn't even picked up the phone if it wasn't for a referral from a trusted colleague who then said, I need to talk to you. The best review I've had from her, is that we agreed a plan, and it wasn't pushy, there wasn't any sales. And the thing that she said was, I came in talking about costs and charges, and now I think about it as the value, helping her with the will, helping her tidy up, previous investments, helping her think about her objectives and priorities, and almost reframing what she wants to do with her finances. So for me, that's a win where the starting point was charges and the cynic, and the end result is the value add. And she's actually referred me to one of her friends. So again, I think that's the bit where you have to have someone coming in the door for the conversation to really show you value. And if someone starts with a cold email of, I've got £500,000 to invest, how much is it going to cost me? It's impossible for us to go into we can provide the death benefits, the tax efficiency, the long-term returns, because we're then on the defensive of, it's going to cost you this, it's going to cost you that. And he'll say, another firm down the road is going to do it for cheaper, but they doesn't know what the value add looks like.
Yeah, absolutely. Completely agree. I realise we're running a little bit long on the podcast. So what I'll do, I'll jump straight into a few questions, and we'll just, I suppose, do quick fire questions and go from there.
Let's go.
First one, I suppose, is I occasionally get it through, especially as it's becoming much more popular, is can we advise on cryptocurrency investments?
So we're a regulated advice firm, and cryptocurrencies aren't regulated investments. So therefore, no is the simple answer. Further to that, I suppose, why would we want to? We want to be looking at liquid, safe investments for our clients, especially when we think about retirement planning. So at some point, as we see those investments like cryptocurrencies become more mainstream and have some sort of regulation and have some more mainstream funds, maybe, but currently it would very much be a personal investment that someone could make if they wanted to. I've got a background in computer science, and I created a token as part of a project. Again, I don't hold any cryptocurrencies and wouldn't suggest that any of my clients did. So again, that says it all for some bits. I should really stick to the quick fire though.
Yes. Next one is, I suppose, regards to qualification level. So minimum for financial advisors a level 4 diploma, but you can also get chartered. What's right and what are the benefits and drawbacks of each?
So to be a level 4 qualified advisor, you have to have done a minimum of 6 exams. at Wealth of Advice, we see that journey as the first 6 being really important for new advisors setting off, but then we encourage everyone to carry on up the journey to be chartered and to be a fellow, to go and have done 15, 20, XXX, all those extra exams. So technically, to be qualified, you only have to have done the 6, and some people do it. But for me, to get the best level of advice, you want the most qualified advisors. I suppose the only caveat to that is a bit like accountants in the time, if you've done a job for 20 years, you can get the qualification that way. So there is an element of on-the-job training. But I would say you do want to be making sure, like you say, your advisor is on the FCA register, but you also want to say, okay, if I've got the option of a chartered firm, I know that they've done all the exams and they're committed to getting to that chartered level.
Yeah, I'd agree. I've met many level 4 diploma qualified advisors that are just as knowledgeable about pensions, investments and others than chartered advisors. But I do think it's almost just the commitment to get to chartered is that much more, and it shows you commitment to the profession to be the best in your field, as opposed to just being that sort of bare minimum.
Yeah, I think one thing I'd add to that as well is all of our technical staff are also working toward that level as well. And the fact that you could have, we've got Jordan, who's our head of investment research. He's, a fellow, he's fully qualified, but his specialism is research and preparing the technical bits. But the fact that he's gone through that journey shows the firm's commitment to get to that point.
Yeah, absolutely. And I suppose the final question is an open one about sort of, do I need a financial planner? I suppose I can start answering it myself in the fact that it depends, and you won't find out until you actually speak to one. Generally, we see more value when you're getting closer to a milestone or there's some change in your life. But when people offer sort of a no-cost consultation, I think it's always worth getting in touch and finding out if you really do need them. Because if they're a good financial advisor, I probably tell people that they don't need financial advice more than they actually do.
I think it's a hard one because people, if they don't understand what a financial advisor does, they don't know if they need it. One positive story I've got on that recently is someone who we've spoken to a couple of years ago and then again this year, who didn't think he could quite afford to retire with the lifestyle he wanted. We looked through some options and he said, okay, I'm going to work for another year. We then said, okay, what about this option? And we talked about the annuity, a guaranteed income. And it was enough, where him and his wife could talk about it and they were happy that would meet all their needs. So he is now, handed in his notice, and is in a process of finishing now where he thought he was going to work for another year. So I think that's where, do you need advice? Nope, you can carry on doing what you want, but sometimes advice can get you to a milestone quicker. And then on the other side of it is a case of, do I need advice because I could just do it myself? Okay, that's fine. But do you know if you're reviewing all the alternatives? Do you know that you're looking at the correct way with tax, with long-term investments, with death benefits and things like that? So I think, again, an MOT, a conversation, and then it's for you to decide, where the value lies.
Yeah, I completely agree. I think that's where I always go with it. In fact, speak to a financial advisor, find out if you need advice and see where the money can go from there.
Yeah, perfect. Well, as always, please like and subscribe. And if you've got any comments, please leave them in the comments below.